in NUE stock. This is Nucor Corp. So this is a third video on our infrastructure thing. Just because Trump and Congress are talking about an infrastructure bill, they were mentioning this a little while ago, talking about 500 billion. Now they're talking about $1 trillion towards infrastructure. And so I think this could be a trend that we actually get happening. I don't know that they're going to actually blast like $1 trillion right now. But over the next year, over the next 5-10 years, I think that the U.S. is going to be focusing on some infrastructure projects and government funded work, basically infrastructure work. And this is number 3 on my list. So I just took a look at Nucor's balance sheet. All right, so Nucor they're a steel, they call them like a mini mill, a steel mini mill. So this is a steel company that will get that government infrastructure money. So this probably a top five kind of company that is on the list to benefit from a $1 trillion huge infrastructure spending bill. And as long as we have these interest rates down for like 2 years or so, Congress has the basically firepower to do this kind of stuff. They're trying to get inflation. They're trying to spend money into the economy. And as long as those interest rates stay down, this is not really helicopter money. I mean, when you talk about helicopter money, you're usually talking about spending, you're bypassing the banks and you're spending into the economy. But helicopter money is usually just like giving money to people that aren't doing anything. Whereas like a big infrastructure bill is actually, it's a government job. So these are government contracts, and that's good stuff because these government contractors generally get overpaid and they have very high security and they get a bunch of you know they get a bunch of money. So um, all I looked at Caterpillar and Vulcan and now Nucor today. Like those are some big ones that look to be getting contracts if this infrastructure bill goes through. And so they're just chatting about the thing now. Who knows how long it would take to pass it? I don't know if $1 trillion is like immediately $1 trillion or what. I don't know. I don't know what the actual infrastructure bill is going to be. But between the infrastructure chatter and the bond buying talk from the Fed, all three of these stocks have just jumped up to a price where they're no longer really interesting. Like this is an immediate kind of hype move. So what I guess I would be thinking about with these is for this hype to kind of chill. Let's see if the stock market turns over. Let's see if it rolls down. I mean, if the stock market volatility decreases and starts moving up and chilling out, that's one thing. If the volatility blows up again and we get crazy stuff, then these kind of companies, these infrastructure companies, this is a longer term thing where they could be good over the next 5 years. They might move big short term if Congress really pushes a bunch of infrastructure through fast, but I don't think they're going to do that. And I think that there's probably a better price point to get in than this one. So, people that are just pumping money into the market on the Fed hype and stuff. I don't know that. I mean, this is not investment advice, but I don't know that these infrastructure companies are really the way to play that Fed hype thing. It's the infotech sector that's still doing stock buybacks. They're still market leaders. They're still getting a ton of flow from international investors, from millennials, from all that kind of stuff. So that infotech sector is really the sector to keep looking at for the hypey kind of stuff. But this is a real sector that can get real money. Nucor's balance sheet is much better than both Cat and Vulcan. It's upside down, but it's like less than a half upside down, like cash to current liabilities. Um, and their cash pile is just barely decreased, and their current liabilities are about the same. And if they're looking at a bunch of government contracts and stuff like that, like I don't think this is one of the last companies I would think of solvency risk for. I was looking at the IWM, talking about how that's a huge mess of companies that have a ton of solvency risk. Um, Companies like this that are government contractors are high on the list of companies that could get bailouts or the bond purchasing help or whatever. Um, yeah, but buying in on a little peak, I was kind of surprised to see these ones up here right now today. But that's probably not a good spot. That's not where I would be looking to pick any of these up. But if we do get a turnover in the market and it kind of gets to a point where it's boring and nobody's talking about it, um, but it still looks like infrastructure is going to be a plan long term, then I'll be very interested in these companies, and I think Nucor is a really good one. Um, Companies that actually make money and have the government as a customer and have decent balance sheets. This is a pretty decent looking thing that's kind of hard to find, but not a good price right here, I don't think. And what should we look at on the general market? I mean, I was looking at. I'll definitely look at the VIX again and the VVIX. So the the VIX. Let me get into a shorter one. The S&P. What is the S&P doing right now? Actually, I haven't looked at it in about an hour. Yeah, so the S&P is just kind of chilling out and consolidating sideways right now, and the the VIX is making a push up, and so the VIX pushing up, and so we got this sneaky little push up on the VIX here, and this was during the island top on the S&P, where the S&P was just going sideways and doing nothing, and the VIX was sneakily pushing up that whole time. So when the VIX is pushing up against a flat S&P, it's a danger zone kind of thing, and that's what we're getting right here is a flat S&P, and a VIX is pushing up against a flat S&P again. And this one was like a 10-day major reversal kind of indicator, and we got a big rip. And then this is a lot smaller, but it is a bit bearish. Let's look at the VVIX, the vol. So volatility of volatility. When you're looking at the VIX chart, this is when the VIX gets choppier, and this is just a general bear market signal. It's just like how dangerous is the market right now, and right now it's dangerous. It's very dangerous. Like down here, below 100 on this chart is not dangerous territory, and we are getting close. We're pushing down towards the things not scary, and then wham, like right back up into the danger zone. Yeah, so this is bear market stuff here. Bear market stuff on these kind of indicators, but on the actual location of the price action, we have tried to get below. This blue line is the 120-day moving average, and so we've been above this thing for a while. And when you get above this, that's bull market territory, and action above that line. Once you solidly get above this line and stay above it, and it starts swinging up, then that's bull market kind of stuff. So right now, this line is still trending down. Because, I mean, obviously we had that huge rip down, and we've just now barely come across this line, and we're still above it. So basically we have. I mean, obviously the fundamentals are super bearish, and they've been bearish for a long time, and the stock market's been high and whatever. Um, like the Buffett indicators and stuff like that. Like everybody knows that the economy is in a recession, and all of the real fundamentals are ugly, and companies aren't profitable, all that stuff. But when you start looking at the VIX, and you start looking at these moving averages, like the VIX is kind of a fuzzy line between fundamentals and technicals. But this is straight up technical, and we're on the bullish side of the technicals right now, and it tried to break down. When it started to get down here, I'm like, oh, now everything is bearish, and we're going to have to see a huge reversal in order for the market to not be like insane bearish. And we got a huge reversal immediately. And so, yeah, so we're kind of in nowhere land here, in between these two major trend lines on the bubble model. This is a 2-year long bull market support line that we've broken, and we back tested several times. And now we want to see if we're going to backtest this line again, I guess, basically. If we backtest this line again, or break it slightly, that is a huge spot to go short in the bear market case. Or if this is actually the backtest of this line and we're done with it, and we get down to the next line and we're unwinding the bubble, if we go down here, then we should break this line and then backtest this line. And that could be a spot to go short as well. So basically, when you backtest one of these major bull market support lines, that is a spot to short. And right now, we're just kind of in between. And it's, I mean, slightly bearish. I talked about the island top. People are saying this is an island top. I'm saying it's not quite as islandy as people think it is. Because if you look at the actual trading action, this gap was filled with some normal activity. And this gap, I mean, has obviously been filled now. Although we kind of do have a gap here now. And we broke up a little bit high into the island top zone. But this consolidation is happening pretty much below the island top zone. So, I mean, people that are pointing at this as an island top, I think this still holds as an island top for now until we break back up into this, until we break back up into here, where the island top actually is. And so as soon as we get up here into this area where people are like, oh, forget the island top, like we've invalidated the island top as like a reversal thing. That's when I'll be saying like, well, whatever, like this is the trend line that nobody even knows about. That is a major trend line that we now have 3 or 4 backtests against. Let me go out to the daily. Let's look at this thing. Yeah, all right. So here's the bull market support line over the last couple years. Volmageddon was here. This is the high volatility thing here, and then we got this crash here at the end of 2018, and this bottom here is the steeper angled run that we got up into the big crash. And so we broke this guy, backtested it, double backtested it here. If you go into the daily charts, you can see more action, but we got a lot of tests along the underside of the line here. And then we broke down, and so I'm like, oh, okay, so we backtested this and broke down to the next line. I thought we were on to the next line already, and we swung all the way back up to the top line. So now we're just reacting along the first line, and in the long-term bear market, if this is a 3-year bear market, if we're on the backside of a bubble, then you would expect to backtest the line and break it. And then you move down to the next line and you backtest that one a couple times. That's just kind of what you do on the backside of a bubble. You build up these long-term bull market support trend lines. And so this 2008 line is a 12-year long line that goes all the way down to the bottom of the financial crisis. And so that's our next line. And that's what I have here is just a bubble model. Like this looks like the beginning of a bear market. So if you look at this 2018, here is a credit contraction cycle in a bull market. So we're still on this uptrending line. And so this is kind of compressed and it's going uphill on a bull market line and actually switches here. We get this super V bottom. Yeah, and that's another thing. Everybody's talking about this V-shaped recovery, the super V shape. And that is a super, super rare thing. You only get that when you switch from one support line in a bubble to a higher level support line in a bubble. And that's a super rare thing that we did here is we went and switched into a higher level bull market support line. And so people thinking that this type of recovery, this is not a recovery. This is a bubble going into a steeper trend line. And that's crazy uncommon. People think that it happened recently, so that's like something that happens all the time. That almost never happens. But this is what happens. This is what happens when you get into a bear market. Is the size and the shape of these contractions is just monstrous because you're going downhill in a bear market. You're on the backside of the bubble, and so you get these huge shapes. And the bear market has high volatility and it has bigger moves. And so that's all these indicators with the VIX being in kind of bear market zone is indicating that these bigger moves mean you're on the backside of a bubble. And so, the everything bubble is like 40 years on the way up. And then it could be 3 years on the way down or something like that. And there's several long bull market support lines, and you break them, you backtest them, and you backtest them. And then once you backtested the thing a couple of times, you're done with it, and then you move down to the next line, and then you start backtesting that one. Basically is how it looks on the backside of a bubble. If you go look at my channel, if you look at like my Great Depression models, my Nikkei models, my housing bubble models, you'll see that this always happens on the backside of a bubble. You build up these bull market lines, you break them, you backtest them. And so we're just backtesting this one now. And we could be done with it. We could move down to this one. Or we could, it's very common to do it twice. A double tap is really common. And that's why I was talking about the island top. So if we get back up here around or slightly above this island top, it should be slightly above because it's an angled trend line. As soon as we hit a high here above the island top, as soon as we hit this and get above it or around it, that's when I will be looking to short this thing really aggressively. And as of right now, I just have like some long volatility and some short on some like the IWM on the Russell. And yeah, so it's a mix. It's a little bit of a mix of indicators here, and it looks slightly more bearish to me. Not so much because of the island top, but because of the VIX. The VIX pushing up. Like we get this big kind of move up and this flat sideways kind of thing. That should be chilling the VIX out, but the VIX is going up against that move, which that's pretty bearish. So if I didn't have the VIX indicator, I would say that this thing is probably more of a bullish looking thing, but that VIX indicator doesn't make me think it's very bullish. And so, yeah, if we move down from here, all the island top people are going to be like, yeah, the island top held up and we're getting to move down from the island top. And that's fine. But if we move up here and the island top people are like, oh, forget that, the market's crazy bullish now, I'll be the one saying like, no, you don't see this trend line that we're backtesting. Like this is a serious bubble trend line that we have backtested a bunch of times now, and that's somewhere to go short. As soon as we get above this island top, that's somewhere to go short. So yeah, that's kind of the bubble outlook for today. We'll see what this thing looks like. I want to see where this thing is tomorrow. What were we talking about? Vulcan or I can't even remember which stock I was talking about. It was a steel company. Yeah, so Nucor, I guess just a couple other notes on Nucor. They have electric furnaces, which makes it very easy for them to, ramp down and ramp up their production versus some other competitors. And they have a good balance sheet relative to, man, almost everybody. Like everybody has absolutely terrible balance sheets. Their balance sheet is pretty decent, and they have a history of investing and expanding during recession periods. So I think that Nucor is actually a pretty good company to take a look at. And yeah, the little price blast today and all of these companies I don't really care for. Um, so this is a kind of a watch list for these infrastructure companies over the next. What was the percentage of GDP that the U.S. is spending on infrastructure? It's like 2.5% or something super tiny, and so that number should be going up over the next whatever 5 or 10 years. And so these kind of things, it's not something to just like jump into. Um, it's you want to find a cheap price and buy these for the long term, kind of. And so we really want to see how this bubble is shaping up. Are we unwinding a bubble? What's going on? Is volatility going to stay high? Um, and these companies' charts are following the general S&P, so it's really important to figure out what the S&P is doing and let it, I think, play out a little bit before jumping into kind of long-term stocks. If we're going to be in like a 3-year bear market, we need to see how these stocks are really doing against the S&P. And yeah, so let's just look at the kind of infrastructure stuff that's going on and what the government's actually doing. And then on the liquidity outlook, yeah, like the Fed's not increasing what they're doing right now. Jay Powell today was talking about not decreasing the balance sheet, but lowering the amount that they're expanding the balance sheet as soon as they see everything functioning okay. And I think these individual bond purchases are a specific look at U.S. financials and the primary banks, just to make sure, because they're getting some weird market activity in um, like trading treasuries and cash and things right now, similar to the repo market stuff that was happening before. And so that's what I think they're doing with these individual bond purchases. Instead of buying funds that have all kinds of tech stocks and everything and whatever in there, like they don't need to buy the bonds of that kind of company. They're trying to support the financial system, and I think that's what the bond buying thing is all about. But that doesn't automatically add a bunch of liquidity into the market. That could actually decrease liquidity, because instead of buying a mess of, like an ETF that hits all these different companies, now they can just add a smaller amount of liquidity just to the financials, or if they're trying to bail a specific company out without splashing in the whole market. And Powell said something like that today, like they're not trying to, I forget what he said, stomp through the market like an elephant or something like that. They don't want to disrupt price action. Um, So, I mean, Powell always says that the Fed is not trying to intervene in the stock market, and that may be true. Um, they really are just trying to support the financial system and keep the banks operating. But of course, the stock market is highly tied to all the financial stuff. So, so yeah, I mean, from what I see right now, the Fed's not increasing their stuff, and the Treasury Congress is increasing all of theirs. And so when the Treasury is issuing more treasuries, when Congress is creating more treasuries, that's taking liquidity out of the financial system and using it for government spending. So that's less liquidity for the stock market. And I'm seeing that trend now, and I'm seeing less stock buybacks and more share issuance. And so we'll see if those trends continue, and let's see how the stock market reacts to all this stuff that's going on over the next week or so. See if this thing actually turns over. What kind of nonsense they're going to say this week. It's definitely been kind of crazy lately. So this is not investment advice, and I do still have a bear market model, and I will continue to have a bear market model until we completely blast out of all this stuff and we get lower volatility. Because I still have these bear market, trend lines that were underneath. We got a massive rejection off of this one, and we have super high volatility still, and so basically I'm going to have a bear market model until we get comfortably out of here, away from this moving average, to where we're technically in a bear market, away from these support lines, and actually using these lines as support and not as resistance from the top, and volatility comes down. So yeah, you'll see me painting a bear market until all of those things happen. And I'm pretty sure that we are in a bear market. And I just have my sights on these two lines right now. I think we're going to be backtesting one of these pretty soon in the next 2 weeks, maybe the next 2 days. We're going to be probably backtesting one of these. And so, I mean, backtesting this one's easy. I mean, we could get up there tomorrow and hit this. But backtesting this one, you got to get through it and do some crazy stuff and then come back up and hit it. So that could take a while. But we might get both. We might hit this, do something, break down, backtest that one. And so that's kind of a look at the bubble model, where we are on our super long-term trend lines here. And we are technically still kind of on the bull side of things, also on the moving averages, on the MACD. If you got to like the daily, yeah, the daily MACD, we're still up here in bull market territory. And so, I mean, this thing really needs to break down to the bear side for this to be immediate bearish stuff. Like, it needs to put in a really good bear move, and it needs to actually get down to the bear side. So this is a bear market, but it's not bearish activity right now. We're still kind of in this bounce. I guess you could call it a bear market bounce. I don't really look at it in terms of bear market bounces, because I'm just looking at these long-term trend lines and looking at the action off of them. So basically, we're just on this trend line right now, and trying to figure out if and when we get down to the next one. And so that's the look, and happy trading.